Hello, everybody. This is Alan Elman, the Blue Collar Investor, welcoming you to another one of my sample trade videos. This one, a real life example with Howmet Aerospace Inc., listed on the New York Stock Exchange under the ticker symbol HWM. It's a trade that I initiated on June 30th, 2025, Monday, and expired on July 3rd, 2025, which is today, the day I'm creating this video. Actually, at 1 p.m. Eastern Time, the stock market closed early today, Thursday, prior to the July 4th holiday weekend. Now, this is going to be a defensive 4 day, really 3.5, covered call trade taken from our premium member stock report. Okay, why did I select Howmet? You're looking at a little part of our 9 page premium member stock report, and I highlighted for you in the yellow row Howmet. You'll notice that the ticker symbol all the way to the left is in bold, which means that all the technical indicators are bullish, as you'll see in a moment. And Howmet is located in the aerospace industry segment, currently ranked A, and it was ranked A last week. We got this particular stock from our BCI database, not one of the IBD databases. And those are stocks we've identified over the last 18 years as potential option candidates. Okay, so now if you take a look at the mean analyst rating, it's 1.56, which is outstanding because 1 is the best and 5 is the worst. Same for the on balance volume. With an up arrow, that's a bullish signal, meaning more cash coming into the stock on up days than on down days. Now, if we move over here to the at the money implied volatility, we'll see a 39.2%, which is robust, almost triple that of the S&P 500 when I entered the trade. Really good for selling options. Now, the option liquidity or open interest has good liquidity, so that makes it a very good candidate for option selling. No problem with the earnings date or the ex-dividend date. Now you're looking at a screenshot of a 1 month comparison chart between Howmet, this orange line at the top, and the S&P 500, the market, the blue line on the bottom, and you could see how Howmet is doing very well compared to that of the S&P 500. Now, if we take a look at the technical price chart with the 4 parameters we use, in number 1, you could see the exponential moving averages or trend is ascending with the shorter term 20-day EMA above the longer term 100-day EMA, and the price bars at or above that 20-day EMA. So the trend is very bullish. Number 2, the green arrow shows the MACD histogram. These blue bars just popped up over and above the 0 line, which is another bullish signal, as is number 3, the purple arrow stochastic oscillator, which is this black line ascending up, also bullish. And finally, number 4, you can see the volume is robust, meaning that the other technical parameters are meaningful. Now, if we take a look at the initial trade entries, you can see I purchased 200 shares of Howmet at 185.40, and I sold the deep in the money 180 call for 597. Now that 597 is not all profit. Why? Because we're going to lose $5.40 on the sale of the stock. The trade management calculator will deduct that 540 from the 597 and tell us that we actually have a time value profit of 57 cents per share. The intrinsic value helps lower our break-even price point from the 185.40 down to the 179.43 in the yellow cell, where you see this broken red arrow. Now, the brown cells will show us the actual time value profit, initial anyway. It's 0.32%, annualized out to 28.9%. Now, initially, we know that we are guaranteed, you see in the purple cell here, a return of 0.32% over 4 days, as long as share value does not decline by more than 2.91%. As you see in a moment, it will. Okay, so now let's take a look just again to characterize our initial trade unrealized status. We generated in premium time value of $114 for the 200 shares. Our cost basis is the call strike times 200 or 36,000. And once again, as I said before, 0.32%, 28.9% annualized, and we're guaranteed that return if share value, as long as it doesn't decline by more than 2.91% in those 3.5 days. Okay, so here's a broker confirmation of my initial trades. Starting number one at the bottom, you could see I purchased 200 shares at 185.40. I sold the 180 deep in the money covered call at 597, and I set my buy to close a good till canceled limit order to protect against share price decline, which I actually needed this time, at 10% of the 597.60 cents. All right, what happened? Well, on Wednesday, guess what? Howmet went down, and it went down a lot. Now, when I researched why that happened, I came up with this, really an aberration. Howmet was removed on June 30th from two major Russell indexes, the Russell 3000 and 1000 value indexes. That means that shares had to be sold because they were removed from those indexes, and that caused a significant price decline. Go figure. In any case, my 60-cent buy to close, good to cancel limit order threshold was reached, and that call, the 180 strike, was bought back. Now I just own the shares. What did I do? I rolled down to the 177.50 and generated $1.15. So I spent 60 cents and generated $1.15 per share, but I also locked in a maximum price of 177.50. So I generated an additional $110 for the 200 shares in premium, but I locked in my losses at a lower price than the original 180. All right. Anyway, I was playing defense, folks. I was playing defense at that point in time. And that was the right thing to do for my conservative approach to covered call writing. So what happens when the market closed at 1 p.m. Eastern time on Thursday? And I'm making this video very shortly after market close. Well, Howmet popped up again to 181.06, still well below what I paid for it, but it popped up from yesterday's declining price. So because of that, the option was exercised. Shares was sold at the roll down strike price of 177.50. So what happens? That means that I lost $7.90 per share. 185.40 was paid, sold at 177.50. Looking pretty ugly, right? But wait a second. Now, the option credit, 652 per share. That's 597 minus the 60 buy to close, plus $1.15 sell to open at the lowered strike price, rolling down, and that was a net option credit of 752. So that means that the actual loss between stock and option is $1.38 a share, or $276. Now, losing $276 on a trade is certainly no reason to break out the champagne. However, the loss without options would have been $868. So the total mitigation using deep in the money covered calls with the exit strategy integration benefited us by $592. So a losing trade, but a lot less than if we simply own the shares. Let's summarize. Significant returns can be initially generated with a 4-day, really 3.5, defensive covered call trade. We can craft our trades based on whatever our assessment of the overall market is, and also based on our personal risk tolerance. Now, in the case of Howmet, we did have a significant initial 4-day return. Yes, we did. But there was also a significant price decline during those 4 days. Now, this is the important part. Not all trades will be winning ones. And I promise to show you losing trades like this one, and I'll continue to do so. But you will see over time, just like I've been doing now for 30 years, many, many, many more of the trades will be winning ones, and that will actually reflect what's going on in my portfolios. But even with the losing ones, we could mitigate our losses through the use of stock options and exit strategy execution. Folks, that ends this video on a sample trade that I executed on Monday with Howmet, a defensive 4-day covered call trade. Folks, I hope you enjoyed this presentation, but most importantly, I hope you learn from these trades that I've been executing. I'm going to show you as many different types of trades as I can. I'm going to show you screenshots walking you through the whole process and giving you the rationale that I use when I execute these trades. So thanks so much for watching these videos. I hope you enjoyed them. And as always, this is Alan Elman, the Blue Collar Investor. Take care, everybody.